Should we start letting people in? Okay, they're coming.
Bonjour, Fabrice. Ah, Quentin, good to see you again.
Bonjour, good to see you too.
Ça va?
Très bien, et toi?
Très bien. Your seminar here was really well received.
Okay, I'm happy to hear that.
Hi, Niels.
Hi, Darrel. Good to see you.
Likewise. Thank you for inviting me.
Thanks for coming. Looking very much forward to it.
We're live on Facebook, and whenever you're ready, Mike, I think you can introduce.
I just want to give a couple more minutes, well, not a couple of more seconds for people to trickle in. All right. Hello, everybody. So welcome to the second day of the Macrofinance workshop. So we're opening today with a keynote speech by Darrel Duffie. It's my distinct pleasure to introduce him. In my view, he's a prince of our profession. He's made remarkable contributions along many dimensions. So I was just reviewing his contributions to research. I kind of knew that they were wide and deep, but still just accounting for this is amazing. He did work on foundational work on equilibrium and complete markets with stochastic differential utility, with heterogeneous agents. He made contributions to econometrics. You probably heard of GMM by Lars Hansen. Well, Darrel did SMM together with Ken Singleton, simulated method of moment, which is if you're doing in macro structural estimation, that's an indispensable tool for your work. Then he invented affine models. He made contributions to credit risk, money markets, search markets, and most recently he's been working on financial system and its reform. So he contributed to research by creating multiple generations of very successful PhD students. His PhD students are now senior faculty in many greatest institutions of the world, who themselves made a lot of important contributions to research. He's an amazing communicator, because if you read his papers, it's kind of geek heaven. He's not shy about using math and all kinds of equations and everything. Nevertheless, he's able to explain his papers to anyone in the most clearly possible way. So PhD students, please take notice that that's how you're supposed to present your research. And lastly, I wanted to emphasize that he's extremely generous with his time. So even if you're not his PhD student, he's always encouraging with junior faculty. He's always encouraging with PhD students from other areas. And he's also ready to share his time. Whenever you call upon him to present, to give a talk, to participate in a conference, he's always ready. The only concern is that he's at a year from now, because he's always booked 1 year ahead. So we're very lucky to have Darrel here with us today to share his insights on the most recent research. So I just wanted to describe briefly ground rules. So Darrel will have about an hour to present, about 50 minutes to present. He's encouraging both comments in the middle of his presentation, and he wants to have a discussion afterwards. So please post your questions in the chat box, and then he'll stop and I'll read out the questions to him. And then in the end, we'll have also time for live questioning. So please be prepared for both. So without further ado, please, Darrel, go ahead. The floor is yours. Thank you.
Mike, thanks so much. And good morning to everybody. It's a great honor to be here. Mike, your remarks were far, far too generous. I'm actually in awe when I look at the very select list of participants that you have here today. And in fact, I'm following in the footsteps of Wenxin Du's work with Ricardo Correa and Gordon Liao in the research that I'm presenting today. which I think, and I hope Wenqin agrees, is an extremely important topic, which is how the sufficiency of reserves, meaning central bank deposits at the US Federal Reserve, affects the functioning of funding markets. And I'm going to focus entirely on the funding market known as repo, or repurchase agreements, which is a $2 trillion per day in transactions market, the most important funding market in the world. And interest rates in that market are representative of the costs of funding the largest banks around the world. This is joint work with Adam Copeland at the Federal Reserve Bank of New York, and with my PhD student, David Young, who's also doing job market theory work in this area, which I think is critical for understanding what's happening. And I'm going to have one slide at the end, which explains why I think it's critical to introduce theory into this highly empirical area, which that is so far highly empirical. All of the work today that I'm presenting that's new is empirical, but motivated by institutions and concepts. As Mike said, I'm hoping we can have a good dialogue. There's a lot of experts I can see in the list of participants. So I'm hoping that Mike is going to relay some questions, whether clarification or disagreement, and then at the end have a good discussion. I'm going to try to keep my remarks relatively brief and not go into great amounts of detail. So with that, I'm going to show you some slides that will motivate what I'm talking about. I want to say first that this is extremely preliminary work. We do have a draft. It has to be polished up a bit, but we have all the results in place. And it also has to be vetted by the New York Fed. And having said that, let me remind, because one of my collaborators is at the New York Fed, that any views expressed by me do not necessarily reflect those of the Federal Reserve System or the Federal Reserve Bank of New York. And that's also the case for my collaborators. But I may say a few things that I haven't vetted myself with my collaborators, because I'm going to be fairly free and candid with my views. There's a lot of policy issues that come out of this. And I'm going to be somewhat opinionated. I'm presenting this, by the way, at Hoover on Wednesday, and I anticipate some pushback on my remarks about balance sheet. So let's talk about the implications of the Federal Reserve System's balance sheet normalization policy on the repo market. That's the main topic for today. The preliminary title, and even the title is not final, is "Reserves Were Not So Ample After All, Evidence from the US Treasury Repo Market." Okay, so let's talk about balance sheet and reserves. So this is a picture of the total amount of reserves, or reserve balances to be more precise, in the Federal Reserve System, and I've broken it into 3 segments. The blue segment at the bottom is the amount of opening day balances, that is at the beginning of each day, the total balances of the 9 most active dealer banks in the repo market. So because the data are anonymized, to me at least, not to Adam, I can't tell you precisely who these 9 are, but I think we all know who are the 9 most active dealer banks. And these are globally. I mean, that is globally, with branches in, of course, in the US, because these are US dollar balances at the Federal Reserve. The blue plus the red is the 100 most active balance bank balances account. These are consolidated by consolidated accounts, the total balances of the 100 most high balance accounts in the system. And then I'm colorblind. The top color is probably red, or no, probably green or yellow. Is that right? Anyway, the top color, the thin slice at the top, is the other banks in the Federal Reserve System. There's thousands of them, but they're not that much in total balances. What I'm going to convince you of, I hope today, is that it's really the blue segment that matters with respect to the core funding markets. And I'll get in more details to that. Now, you can see that around 2017, beginning of 2017, there's a gradual decline in the total balances in the system. This is not an accident. The Fed announced a policy of balance sheet normalization and decidedly started reducing the total amount of reserves in the system at that point. And explicitly in the FOMC minutes, they said they would continue to reduce balances until going any further would interfere with the efficient functioning of monetary policy. And I am going to basically relay the story to you that they underestimated, and it wasn't an easy job, but they underestimated where that minimum would be. And they were just about getting to the point at which they would start turning back up again at a slow rate in September 2019, when it became apparent that they had gone down too far. There were not enough balances in the system. And the repo markets went really, that is funding markets in general, but repo markets in particular went really quite dysfunctional. I'm going to show you some evidence of that. If you look carefully, you'll see some periodic notches in these balances. These are not entirely random. There are some notches, and these are related to calendar effects and Treasury issuance effects that I'll get to. And they are important. So what happened? Well, repo rates sometimes, during this balance sheet normalization period, repo rates sometimes went far above their arbitrage level. Let me explain that. The arbitrage level for Treasury market repo rates should be the interest rate offered by the Federal Reserve on central bank deposits. That's called IOER. What you're looking at in this diagram is the spread between two different repo market indices, which I'll explain, and the interest rate offered on excess reserves, IOER. And why should that spread be zero if there's no arbitrage? Well, any bank with balances, and there were lots of banks with balances, could make the decision, should I leave my deposits at the Fed and earn IOER, or should I invest my cash deposits in the repurchase agreement market, take Treasury collateral, a perfectly risk-free investment, just like deposits at the central bank. And according to this diagram, I could occasionally earn substantially more than the interest rate offered by the Fed on my balances at the Fed. So banks should have done a lot of that, and they didn't, obviously, because the spreads were generally positive during this era of normalization, and sometimes spiked well above the arbitrage spread of zero. Now, there's the largest spike, which is the one I mentioned a few moments ago, is September 2019. And in order to fit it on the diagram, we actually truncated. It was 315 basis points of spread, and we truncated it at 150 basis points so that you could see all of the other spikes in proper relief. And they are substantial, and they do occur with some periodicity. And lest you think that the periodicity of those spikes, which seem quite regularly spaced, for example, in this period here, lest you think that those are all some sort of quarter end or period end balance sheet capital requirement effects, that is not the case. These spikes correspond more often to Treasury issuance dates, dates on which, after a Treasury auction, the Treasury issues securities that must be paid for, typically by these same 9 largest dealer banks, or by their customers through them. But there are also calendar end effects that are not related to the sufficiency of reserves in the system, at least in a precise sense that I'll get to later. The 2 time series that I'm plotting here are SOFR minus IOER and what we're calling VWater minus IOER. Let me unpack those. SOFR is the secured overnight financing rate. This is an official index provided by the Federal Reserve Bank of New York. It's going to replace LIBOR as the short-term interest rate benchmark for the world in US dollars. And it is not entirely comprehensive, but it accounts for around $1 trillion of daily transactions. So these are overnight repo rates that are recorded by the Federal Reserve Bank of New York, combining across different segments of the market. And the most important 2 segments for today's discussion you can think of as the segment by which the dealer banks are borrowing funds in the repo market, which is sometimes called the tri-party market, and the segment in which they're lending funds in the repo market, which is a combination of the interdealer market, where they lend funds to other smaller dealers and each other, and also some of the bilateral repo market, which is difficult to map and it's not comprehensively collected. The Fed also tries to get rid of specials by dropping out the repo rate transactions that seem to indicate that securities are on special. So it's an attempt to get towards a general collateral rate. VWater is a customized index that we put together using transaction level data on the Tradition interdealer trade platform for repo. And we constructed from intraday transactions a daily index, which is volume weighted. So volume weighted average Tradition repo rate, VWater. And you can see that these interdealer rates are slightly above the SOFR rates. That's not the main part of the story, but we're going to look at both segments of this market. Okay, so here's something that, by the way, everything that I've said so far, the gist of it at least, you probably would have gotten from the paper by Correa, Du, and Liao that I cited earlier. And what we're going to do is we're going to focus on the specific positions of the largest 9 repo dealer banks in the market. And we're going to focus on the intraday payment stress of those 9 dealers. And we're going to try to ascribe most of the variation in these repo spreads to IOER. We're going to ascribe most of it to intraday payment stress. And I'll get to that later. But first, what does this chart say? Well, here is this same, the repo rate spreads are on the right-hand axis. So in red on the right-hand axis, you can see this plus 300 basis point spike in the market. And the reason the repo rate spikes, I think it's now pretty much conventionally agreed, is that the amount of reserve balances in the system were not enough to meet or at least the shadow price of those reserves in the system was enough, was tight enough on those days to cause that spike. What's not commonly understood is that when the Fed reacted by flooding the market with reserves in September 2019, in order to meet that shortfall, basically the Fed said, we were wrong, we overshot, we're going to add reserves to the system. They added a lot, about $600 billion over the next few months. What's not commonly known is that if you look at the reserve balances of the largest dealer banks, which are in blue on the red scale, from the beginning of September to the beginning of the COVID crisis at 1st of March 2020, the total reserve balances of those 9 dealer banks did not go up. I mean, it fluctuated up and down, but it was basically back where it was at the beginning of September. And what that meant was at the beginning of the COVID crisis, when there was a flood of demands for funding in the Treasury repo market, the rates spiked again. And so even though the spike doesn't look that big because it's compared to that giant 300 basis point spike, it was a very substantial crunch in the repo market in mid-March. So what really matters is not total system-wide reserves. What really matters is how much reserve balances are available at the opening of the day for the 9 repo active banks. So this is an indication of significant frictions in the repo market. And those frictions, I think, will probably come up in discussion. But basically, you can imagine that of the other thousands of banks in the Federal Reserve System, very few of them have active repo trading desks and active relationships with the 9 repo active banks that are intermediating the market. So in terms of either search friction or account registration and counterparty relationship frictions, the market is not that efficient. You'll see that immediately after the COVID crisis, the Fed flooded the market with reserves. That wasn't so much because of the repo market frictions, although the Fed was concerned about that. As most of you know, the Fed decided that the cash treasury market, where treasury securities are traded, was highly dysfunctional, and it basically absorbed, in the first 3 weeks of the COVID pandemic crisis, it absorbed $1 trillion of US treasury securities, and the largest single central bank open market operation ever conducted. And a byproduct of buying all those treasuries was the creation of an enormous new amount of reserves, which did increase, which did increase the total reserves of the 9 repo active banks. So this is a byproduct of the Fed's purchase of Treasury securities. And when it purchased Treasury securities, you can see it flattened the repo spread to IOER. So the repo market returned to normal functioning. It was actually much better even than in the intervening months because there was a ton of reserves in the system. So the story is ample reserves means really ample reserves, and it means roughly more than 600 billion of reserves for the 9 repo active banks. So a question I often get when I talk about this is, well, how much is enough? And I would say it's like a thermometer. Keep adding reserves to the system, at least with the current market structure, until you get the 9 repo active banks above 600 billion, and then you should be about right. And that is a lot more than people had guessed. And we're going to get to why. And I'm going to also watch the time. Mike, if there's any urgent questions, I could handle anything right now.
Andrea has a comment. Andrea, go ahead.
Oh, actually, I have a comment and a question. So, hi, Darrel. Good morning.
Good morning. You're up early.
I know. I just teased Mike about that. So first question was about the kind of relatively short time series. So I just pulled up Fred and saw that excess reserves in 2017 were kind of just where they were in 2014. So is there something worse about the later half of the sample than what we saw in 2014? And then my other, so that's more of a comment. And then the question is about, does the distribution of the reserves matter? Or is it just the aggregate of the 9 dealers that has to be above the 600?
Both superb questions. And on the first one, I'm going to emphasize the importance of regulatory and supervisory requirements for liquidity of the 9 largest dealers post 2014. And for the second question, trigger me again, what was the issue?
Yeah, it's just, does the distribution of the reserves matter, or just the aggregate?
Okay, so the distribution matters. We conducted, I have a slide near the end on the Herfindahl index for the distribution across the 9 repo active dealers, and it does matter. And if you want to know the direction, you might have 2 hypotheses. One is when you get more concentration of reserves among the 9 large dealer banks, then whoever has the most is going to exercise market power and the spread would go up. That's one hypothesis. Second hypothesis is if there's a high concentration among the 9 large dealer banks, that means there's not very good sharing among them. There's inefficient sharing among them, so you get more stress in the market because of uneven balances, and the repo rates will spread higher. Do you want to guess which of those 2 hypotheses is the more empirically consistent?
So I wanted to put a third hypothesis on the table, which is that, maybe there's one bank that is the most efficient, holder of the excess reserve. So would go the first way, but for a different reason. But no, I don't want to guess. I want to know the answer so I don't look dumb.
So first, it's a mild effect. It's not that big. And secondly, the more flat the distribution of reserves is across the 9 dealer banks, the lower is the repo rate spread. So basically, it's an issue of, is there enough reserve spread, sorry, the other way around. The more flat the distribution of reserves across the 9 dealer banks, the lower, I said that right the first time. In any case, the issue is not the concentration of market power. It's not the case when you have a high concentration with a few dealer banks that you get wider spreads. It's the other way around. And that seems to indicate that it's just basically sufficiency of total balances among those banks. And I'll come back to that. So let me, because we're almost certainly going to run out of time, I can see that now, it's a pretty rich topic. Let me just summarize the major implications. And the first one is already soundly in the paper by Wenxin Du and her collaborators at the Fed. So what they showed and what we confirm in spades is that it's absolutely crucial for the intermediation of US dollar funding markets that reserves are ample in the system. Okay, so we're just confirming what they said in that respect. But what we're going to do is we're going to dive down, let's say, under the hood of the Treasury repo market and look at why with so much, over $1 trillion of reserves, which which is way, way more than what was available before the financial crisis of 2008, why that isn't already very ample. And this kind of goes to one of Andrea's questions. So we're going to go under the hood and see what's going on. And we believe that it's first, how much reserves are held by the 9 large repo active dealer banks in aggregate, and also a little bit in distribution. And the reserve balances of the other banks play no significant role in all of this. We're also going to show that the channel for this is mostly related to intraday payment timing stress. And I'm going to go through that in quite a lot of detail. That's actually where I'm going to spend almost all of the remaining time, and focus on payment timing stress. Now, there are other explanatory variables that are statistically important, and I believe all of these are in Wenshin's paper, and we're getting generally similar results that are in Wenshin's paper. So end of quarter effects, which is related to capital requirements, Treasury coupon issuance. It's coupon issuance that's more important than bill issuance. And net dealer treasury positions, that is how much treasury securities, this is on the demand side, how much treasury securities the dealers need to finance, that's basically demand for repo. So this is a story of supply and demand in a market with, over-the-counter market with frictions. Okay, the easiest way to answer this question is to just ask, what did Jamie Dimon say about it? So I'm going to spend a minute on this. So after the September repo crunch, a research analyst at one of the banks on the earnings call at JP Morgan asked Jamie Dimon, why, last year in 2018, he said, when the repo rate spiked, you supplied reserves to the repo market and you made money. Why didn't you do that in September 2019? You had lots of reserves. Why didn't you supply more of them into the repo market? And Jamie Dimon said, let me see, got to get this out of the way. I'm going to read verbatim what Jamie Dimon said and interpret it as I go. So, quote, we have a checking account at the Fed. So this means the deposit account of JP Morgan at the Federal Reserve, with a certain amount of cash in it. Last year in 2018, we had more cash than we needed for regulatory requirements. So when repo rates went up, we went from the checking account, which was paying IOER, into repo. Well, parenthetically, that's the arbitrage that was supposed to have happened. Continuing, Dimon says, obviously makes sense. You make more money. But now, meaning after the September 2019 event, now the cash in the account, which is still huge, it's 120 billion in the morning and goes down to $60 billion during the course of the day and back up to 120 billion at the end of the day. That cash, we believe, is required under resolution and recovery and liquidity stress testing. So let me unpack that. Later in Dimon's response to this question, he talked about the red line below which JP Morgan cannot let its reserve balances go lower because they are required by regulation and by supervision to maintain a very liquid balance sheet, including a high emphasis on reserves. And that's in both regulations and in the supervision side of their bank. So if the red line is 60 billion, that means they don't have a whole 120 billion to put into the repo market or whatever else comes along that's profitable. They can only keep spending during the day until their intraday balances go down to 60 billion, and that's it. So a lot of those balances are tied up. You might say, well, 60 billion, they can only go down from 120 to 60. That's still a lot of money. So, why is it that there still isn't very ample reserves? The answer is it takes a heck of a lot of money to run the payment system, and it always has. Even before the financial crisis, when reserves were not very much, the large banks used to run very, very large overdrafts intraday. And when they ran those overdrafts, they were basically meeting the needs of the payment system. But post-crisis, they don't have access to that extra overdraft because the red line for supervision and regulation is well above zero, not below zero. So that's basically the story of the paper. but I'm going to continue by giving you more evidence on that. Assuming my slides cooperate. There we go. I'm going to skip that slide in the interest of time. So let me give you my first of several pieces of evidence that this is all about intraday timing stress. On the horizontal axis is the repo spread that we've been talking about. And I took the tradition repo rate from the first 20 minutes of the day, which is the most active time. And it's the time at which the dealers are thinking about what repo rate today should we lend in the market relative to IOER based on market conditions, which include our opening balances and everything else. One of the things they're thinking about is, when are we going to get paid intraday? And what's plotted on the vertical axis is the time of day net of the average in the sample at which they get half of their incoming payments. So let me repeat, 100 on this chart, which is a stressful day, means that these 9 banks are getting paid 100 minutes later than normal in terms of when they get half of their incoming payments. Well, that means there's intraday payment timing stress because the market is freezing up to some extent. All market participants are saying, gosh, this could be a day on which reserves are quite scarce. We better not pay out until we see more incoming, because otherwise our balances will get too low. And this is obviously a self-fulfilling effect. And so the theory needs to account for that strategic complementarity of when one bank is anticipating that other banks are going to pay them later, then they will also pay later. And you'll get this freezing up or cash hoarding effect. Now you can see the relationship between late payments and high repo rate spreads over IOER. The red dots on the, this is on a log scale, by the way. So as you can see, the 1 basis point in the middle of the chart, not very big, then it goes to 16 and then 256. So those red dots are the days on which repo rates over IOER were highest. And the far upper right-hand dot, that's September 17th, 2019. That's the biggest repo crunch day right there. And that's also the day on which median payments coming in were way late relative to normal. So that's intraday payment timing stress. Here's another indication. On the horizontal axis is the average daily dealer bank balances within 2-week settlement periods for the 9 large repo active banks. The vertical axis is for the whole system for which we have data, what's the peak overdraft in billions for the system within that 2-week settlement period. You can see there's a very strong relationship, R squared is 60%, showing that as the average daily balances go down, there's more overdrafts. So this whole period is all ample reserves. Every dot in this picture is during the quote unquote ample reserve period. If reserves were truly ample, why is there such a close relationship between overdrafting and the level of reserves of the dealer banks? Again, this red dot here is the dot corresponding to September the 17th, 2019. It is a day on which this is a settlement period. That 2-week settlement period is corresponding to the lowest of all time during the ample reserves era, lowest of all time average dealer balances, opening balances, and the highest overdrafts in the system. Okay, at some risk, I'm going to show you this regression table, but I'm not going to walk through every single coefficient because otherwise we'll run out of time. I'm going to come back to payment timing stress in a few moments. Before I do that, maybe I should ask Mike if there's any pending questions.
No, there's nothing. No.
Good.
I have a quick clarifying question, Darrel. So this is yeah. So on the previous slide, the overdraft is at the Fed or the private facility, like with Bank of New York Mellon.
So this is overdraft at the Fed. So this is a Federal Reserve System series. And by the way, I don't mean to say that these are alarmingly large numbers. They're actually tiny compared to pre-crisis.
Right.
Let me emphasize that point. Pre-crisis, the large dealer banks were running enormous overdrafts, and they could do that because they were under no regulatory or supervisory requirements, to maintain a high level of liquidity on their balance sheets. Post-crisis, they couldn't do that. They lost that buffer. And so overdrafts were very small. But at least as a signal of tightness of reserves in the system, overdrafts are still quite relevant, exactly as shown in this diagram. Okay, again, at some risk, I'm going to dive into a regression table. And let me just start with what's the story that we have here. The story is that when dealer opening balances are low, there should be a higher than normal level of spread of SOFR over IOER. And it is about the range of variation in dealer balances. Well, you can see that in the previous picture. It ranged from about 440-ish up to about $1 trillion during the sample period. So that's a range of 600 billion. So this is about a 30 basis point effect. That's a big effect. Now, it's not big enough to explain a 300 basis point spike. I'm going to get to that later. If you just used the median time of receives, that is this payment stress index, which is how much later than normal are those 9 banks getting their incoming payments, that is a big effect. 100 minutes late, which as I showed is not unusual, is a 13.5 basis point effect. And the R squared for that number is actually bigger than opening balances. So if you really want a direct measure of where stress is in repo funding markets, go to timing stress, because that is a great signal of whether or not there's enough reserves in the system. If you combine the two, you drive your R squared up to about 37%. And the relative, of course, each one of them goes down because they're related to each other. And then if you add in the quarter end fixed effect, and this is well discussed in Wenshin's paper because their paper focuses both on capital requirements and on liquidity in terms of reserve balances, you get a similar number. They report a similar number for this. And these numbers are pretty stable. So the quarter end effect is a capital requirement effect. I'm not going to dwell on it today. It's pretty interesting, but we just don't have time. And it's not that novel to this paper. It's in Wenshin's paper. There are other effects like net treasuries inventory. This is on the demand side, not the supply side of reserves. The more inventory there is to be financed, the higher the repo spread. This is a sign of very inefficient over-the-counter markets and search markets. Now, there are some additional effects. These are also covered in Wenshin's paper, which are the redemption of treasuries. Why does that matter? Well, because when the Treasury Department redeems Treasury securities, that money goes first into the large dealer banks, or mostly into them, and then they distribute it. And when that happens, it lowers stress in the repo market. There's also bill issuance and coupon issuance. We split these apart because although it doesn't show up big time here, if you look in the tri-party segment of the market, there's a big difference between the effect of bill issuance and coupon issuance. And that has to, if you look in the GCF market, which is the interdealer market, there's a big difference between these coefficients because coupon securities are highly circulated in the repo market relative to bills. Okay, I'm going pretty quickly here, sorry. I'm going to skip this. Well, it just basically says, is this happening in the other repo market segments? The answer is yes. The other segments here are the GCF, which is the interdealer market, the tri-party market, and then this is a variant of the interdealer market. And they're all there, although to different degrees, you get different effects. Like in the GCF market, the quarter end effect is bigger. And that's in part because it's an interdealer market. I'm going to come back. I don't have time to go through this in any detail right now, but what I want to do is basically try to summarize in the last few slides the takeaway. First takeaway. It takes a lot of reserves to saturate funding markets, a lot more than one might have thought, and a lot more than the Fed thought. The Fed also, by the way, conducted surveys of the large banks and said, how much would you need to make sure that you had enough? And they added that all up. It came to about $800 billion in total for the system. And that is what they estimated. And in fact, the whole system had 1.5 trillion, almost twice as much. So it takes a lot more than you would think. And when the 9 dealer bank balances get below about 600 billion, you start to see this stress. The spread between SOFR and IOER is much above normal. SOFR is the blue dots. And the tradition repo spreads are in the red dots. So there's a spread between the two. But when balances get below 600 billion, there is stress in the system. And you can see some of these dots are way above normal. And there's truncation above the 60 basis points here. Next takeaway, and this is a new thing that we just added to our paper in the last week, very preliminary. If it's really about intraday payment timing stress, then it's not opening balances that matters as much as the minimum balances that are achieved during the day. Let me repeat that. Let's say JP Morgan had 120 at the beginning of the day. At the minimum, it only had 60 billion. That was Jamie Dimon's comment. So really, it's 60 billion is the measure of available reserves at the worst of the day. That's the measure of sufficiency of reserves that matters the most. So to see if that mattered, we took total opening balances and we subtracted the aggregate across the 9 dealer banks of the drop in balances from the opening to the minimum of the day. And if you do that, and you plot SOFR minus IOER on a log scale, so the numbers here are in basis points, but you can see it's a log scale, you can see a very good relationship. And you can see that these spike days are the days on which total opening balances minus balance drops gets down to around 300-ish billion, you get the really big spikes. So that's really what matters. If you combine those in a regression as separate variables, you can see they work together, at least in this simple relationship. So the spread between SOFR and IOER, a constant minus 2.5 basis points per 100 billion on opening balances, plus about 2.5 basis points per 100 billion on intraday balance drop. Then there's the median receive time variable, which is very statistically important. It's another measure of payment timing stress. And then there's this quarter end fixed effect plus the residuals. This is taking longer than I thought, but let me just mention a policy viewpoint by Joseph Gagnon and Brian Sack, which they put out in a white paper after September 2019. These policy points are something that I think could be the basis for a discussion in a few minutes. So what they said is, first, the Fed should implement a standing fixed rate repo facility from which a set of counterparties, including banks, could borrow at a rate modestly above the rate of interest the Fed pays on excess reserves, or IOER. So what that would do is it wouldn't chop off the spikes perfectly because it's an imperfect market, but it would take the tops off of most of those spikes because anybody could go to the Fed, at least anybody who has access to the Fed, in a wider set of counterparties than merely the primary dealers. Second bullet point, and by the way, that's complicated. We can get to that in discussion. Second bullet point, the minimum level of reserves, meaning the minimum level necessary to run the payment system and meet all the needs of market participants, that minimum level is conceptually murky. It's impossible to estimate and likely to vary over time. The best approach, here they mean from a policy viewpoint, the best approach is to steer well clear of the minimum, especially since maintaining a higher level of reserves as a buffer has no meaningful cost. That last phrase, has no meaningful cost, that is a highly politically charged statement. There are, or at least it's a very sensitive policy statement. There are many who believe that it's very costly for the Fed to have a large balance sheet. So that may come up in discussion. This last point is a bit more narrow, but it's also relevant. The Fed is now targeting the federal funds rate as its policy rate. Maybe it's important that the Fed think about targeting the repo rate. Why? Well, because the repo rate is 20 times, literally 20 times larger than, that is, the repo market is 20 times larger than the Fed funds market, and is by far the more important funding market for wholesale US money markets. And when you see the repo rate spiking over IOER as much as it has been, you kind of get the impression maybe paying attention to the repo rate is very, very important as a matter of monetary policy transmission. Okay, let me go one more theoretical point, Mike. But this is a good point for questions if there are any.
Gordon Lau has a question. Gordon, go ahead and ask yourself.
Hi, Darrel. My main question is, I'm not sure whether you're are familiar with the Fed Now services that the Fed is trying to develop, but I was wondering whether you think a transition to real-time gross payment with more counterparties around the clock through Fed Now instead of FedWire could lessen the intraday reserve needs by dealer banks, or would it worsen some type of this strain because it will be less batching of payments by the banks, since you're
Fantastic question. Fantastic question, Gordon. So for those that are not on the inside of this, by 2024, the Fed is going to have, or says it's going to have, a fast payment system, which will mean 24/7, 365, you can send payments anywhere, and it's going to be real-time gross settlement, so there'll be no delays. And so money will move faster in the system. Here's why I don't think that will necessarily make a big difference. The incremental use of Fed Now, most of it is going to be at the retail level. There already is a, quote, fast payment system for the repo market, which is just FedWire for adding and subtracting reserve balances among the largest banks. It will give access to the fast payments to non-bank institutions, but really the most important ones for the repo market already do that through their clearing banks. So I don't think, I think FedNow is a really important contribution to improvement in the payment system. And in gross, it will lower the amount of payment timing stress, but not for the largest repo active market participants. Not very much, at least, I would expect. There is another alternative the Fed is discussing, which is central bank digital currency. Chair Powell said, we're not in a hurry, we want to get it right and not necessarily be first. And that would also speed up payments because central bank digital currency is kind of like FedNow, but it's based on central bank deposits by everybody. The reason I don't think that will necessarily help is that it bifurcates the payment system into two kinds of payment media, which are electronic reserve balances and central bank digital currency balances. Unless the Fed works out a way to make those two fungible, it could actually make things worse. Okay, I'm gonna finish up and then we still have a few minutes for discussion after I finish up. Here's a theoretical point. Look at that spike in September 2019. And I actually raised that question when I was the NBER discussant for the paper by Gordon and Wen-Shin and Ricardo Correa this summer at the NBER Summer Institute. I said, whatever empirical model we're going to use, there's no way that when reserves are fluctuating kind of like that all of a sudden in a reduced form empirical model, you're going to say, today is the day on which you're going to get a 300 basis point spike. It's just not going to happen. There's no reasonable reduced form empirical model, at least not one that's informed by a whole lot of theory, is ever going to explain that spike. So what explains it? What theoretical concept could make the repo market so unstable that with a small reduction in reserve balances, and by the way, this is the dead minimum level of reserve balances by the 9 large repo active banks, the same day that spike occurred or within a day. What would make a small reduction in reserve balances cause all of a sudden a huge spike? Well, it's got to be something about, in my view, something about self-fulfilling expectations that there's not going to be enough reserves. And sure enough, theoretically, it can be explained in that way. And it has been in our co-author's job market theory paper. This is David Yang's work, not ours. And basically, he's saying that if a bank thinks that other banks on average have, say, 59 billion of reserve balances, well, the repo rate will be here. If it's 58, a little bit higher. If it's 57, less reserve balances, higher repo rate. But once you expect the other banks to get below some threshold, you, a dealer bank, a specific dealer bank, are going to say, wow, you know what? If it gets any lower, then probably people are going to start paying me later in the day. And they're going to be thinking about me paying them later in the day. And we're both going to want to pay even later in the day in order to make sure that we don't go below our minimum by an excessive amount. So we're all going to start hoarding balances at some threshold. And the repo rate at which we're willing to offer balances to others at the opening of the day is going to jump way up. So that's, again, a perfect Bayes equilibrium notion of a self-fulfilling jump in the repo rate associated with a threshold in balances at which there is a joint expectation of everyone hoarding cash, hoarding their reserves. So with that, let me just turn it back to you, Mike, and see if there's any remaining discussion.
So there are no new questions, but now feel free to raise hand and we'll call you out for questions.
I guess I can get started to ask a question first. Yeah, it's very interesting. So my question is, you mentioned the 600 billion tend to be a magic number among the top 9 dealers, but sort of going forward, now we're in the environment where the shocks are obviously larger as well, right? Thinking about the daily fluctuation in the Treasury general account balance under COVID, when the TGA balance is over 1.5 trillion, whereas it used to be maybe 200, 300 billion. So do we still think that 600 is a good number, or maybe number are actually going to be much larger going forward?
Well, it's, first of all, it's going to be a lot larger because the Treasury market is growing much, much faster than the dealer bank balance sheets are growing. And so the dealers are not going to be able to intermediate the market unless they have a lot more liquidity and capital. And so, you know, right now the Treasury market is at 20 trillion. It's expected to grow to 120 trillion within 30 years. And the dealer bank balances are growing roughly with GDP over the last 10 years. So they're going to get overwhelmed unless there's a change in market structure. So I would expect, both from the viewpoint of capital and reserves, they're going to need a whole lot more. Now, there is a natural way to correct that, which we saw in March, which is the Fed just absorbs a lot of those treasuries and floods the dealer banks with reserves. And that reduces both that increases the speed with which the dealers can get the stuff off their balance sheet, which helped a lot in March. And it also flattens out the problems in the repo market with insufficient reserves. So as I mentioned before, a byproduct of the Fed's quantitative easing or LSAP's program is that it's flooding the market with reserves and eliminating this problem. So I don't expect it to come up unless and until the Fed tries to renormalize its balance sheet. But you're exactly right. The 600 billion is as of, you know, the beginning of 2020, 600 billion is enough. But with increases in all kinds of things going on in markets, that number could be much higher.
All right, Adrian Devernas has a question.
Hey, Darrel. I'm going actually to present a very related paper in 1 hour. But so would you agree that an intraday facility, so like a discount window, but during the day instead of overnight, could resolve most of these tensions in repo markets?
Yeah, and that's the standing repo rate facility that was mentioned by Gagnon and Sack. They were one of the first to suggest it, not long before September 2019. And I do think there's also a paper by Andolfato and Irig from the Fed suggesting that such a facility could mitigate the problem of days on which there doesn't seem to be enough funding in the repo market. And yeah, I think it has a lot of promise. There is a complication though. It means that the Fed has to open up its balance sheet, not just to the primary dealers, but to a wider set of market participants in order to mitigate this problem. That's the whole idea of this facility. And now the Fed has to do counterparty risk management for a wider set of people. The Fed is also expanding its footprint into money markets. And some might argue, well, you know, the central bank shouldn't, quote unquote, be the money market. It should just be a last resort provider of liquidity, not an everyday provider. On the other side of this, there's the monetary policy transmission issue. And there are very strong proponents of a corridor system, which would require probably something like this repo facility to make it work well. So overall, I think it's a good idea, but it's not simple.
All right, next one is Kairon.
Okay, thanks so much, Darrel, for this very interesting talk. So I just want to follow up with Andrea's observation that it seems that before 2014, especially before the crisis, the Fed is able to run with very little excess reserve in the system. And, you know, I fully agree with you. That's the problems created by the post-crisis liquidity and capital regulation. So I guess instead of trying to, so in other words, the technology, the payment technology was already adequate for us to handle this payment. So it seems that now we're coming up with this real-time Fed wire technology or like central bank currency, but it all seems that we already have the technology to handle the payment. So my question is that would it be easier just to fix the regulation we introduced after crisis? Specifically, if we count this reverse repo backed by Treasury on bank's balance sheet as high quality liquid assets. So if banks see there's a large RICO spread, they can just swap their central bank reserve into reverse repo without violating liquidity regulation. Would that eliminate the problem instead of introducing many other problems?
Okay, so fantastic idea. And you're not the first person to think of it. The vice chair of the Federal Reserve System, Randy Quarles, immediately after that September crunch that happened here, said, you know what, maybe it is. In fact, he said it probably is the regulatory and supervisory requirements on banks to maintain a high level of intraday Federal Reserve deposits. Maybe we should allow them to count toward their liquidity requirements, their access to the discount window. Again, that would do, essentially it's what you just proposed. And that idea that was floated by Vice Chair Quarles has actually not been implemented in the United States, but it has been implemented in Australia, where the Reserve Bank of Australia allows its regulated banks to meet their LCR requirements and other liquidity requirements by counting towards those requirements their access to the discount window at the Reserve Bank of Australia. So it has been tried. It's actually, I think, a very good idea. And the RBA does it at a fee. So there's an undrawn fee of, I think it's about 10 or 15 basis points for access to that. So the Australian banks can basically pay the central bank to meet their liquidity coverage requirements by virtue of access to the discount window. So I think it's a very good idea. And it would mitigate a lot of these problems. Also, you know, the Fed tells the banks, well, don't worry about drawing down your intraday balances on a stress day. We're not going to penalize you, but the banks are just very reluctant. And, you know, they want basically a signed memo from the Fed saying that this would be fine. And I think it may take not just what you suggested, but possibly also more reserves in the system. For now, we don't need to worry about that because there's a ton of reserves.
Right, next question is from Scott Richard.
Scott,
are you there? You can just unmute yourself and go ahead.
Can you hear me now?
Yeah. Yes.
Okay, good. I thought you were encouraged. Hi, Darrell. How are you? Very interesting talk. You answered my question before I could ask it, which is, can't the Fed do something about these precautionary reserves? What's the big deal if they're violated? And you're saying the banks are scared that the Fed doesn't really mean it when they say, go ahead and run your reserves down.
Yeah, I think that's the case. I mean, that's what Jamie Dimon said. And the Fed did let the banks know, if you really need to use these for liquidity, go ahead. We're not going to ding you. But you know, if you're a mid to high level manager and thinking about your career, and you're the one that goes through the red line, and then something goes wrong, or you get a letter, your supervisor calls your boss and says, what the heck are you doing? It's just not worth the risk.
Right. So they keep these enormous reserves. Have you considered looking at this on a look-through basis? If we consider the banks and the Fed together, the Fed right now is merely holding all the treasuries and mortgages the banks would normally hold. And so I'm not sure there's anything unusual about the aggregate balance sheet. So does it matter whether it's the Fed holding them or the banks themselves? If they have better lending opportunities, would they just ask for their money back?
Right. So from a system-wide liquidity viewpoint, no, on a given day, I don't think it matters because the Fed has a liquidity and it can substitute for the bank's needed liquidity. The Fed can just simply tell the banks, look, we can create liquidity at will and meet your problems. Just come to us. However, that's a moral hazard problem. It means that the Fed is saying, we've always got your back. You don't need to worry about running a balance sheet that's very illiquid. We'll be here. And banks might, if they took it to heart, they might lean so heavily on the Fed that their risk management for liquidity would not be that good. And I mean, that's what the Fed says in terms of why they don't provide, liberal liquidity at all times to all banks.
Final question. Does anybody in the world, what I'm going to call a real central bank, manage repo as their primary policy tool?
Yeah.
Is there a model?
Most central banks.
That's what I thought.
Yeah. Yeah, it's quite anachronistic that the Fed uses Fed funds. It used to be the case pre-crisis that Fed funds was a really good target rate because scarcity of reserves in the system was easily the method by which the Fed was steering interest rates. But that's just no longer the case. The Fed funds market is a minor carbuncle on the monetary system. It's tiny and it's not really much of an interbank system.
All right, the next question is from Quentin.
Yes, so in Wenxin's paper, she's looking also at FX spread spreads. And I was wondering, so this tends to spike at the same time as the repo market, but not always. So I was wondering if you think that in the intraday constraint is also the constraint for FX, or if there is something else happening here.
So that's a great point. And let me just emphasize for everybody that the paper by Wenxin and Gordon and Ricardo is not specifically only about repo. It covers funding markets from a general perspective, and they lean on both the repo market and the FX market as both of those are what they call reserves draining intermediation activities by the large banks. So when the large banks are supplying liquidity to FX or repo, they're drawing from the same pool of intraday balances. And so you should expect exactly the same kind of pricing effects, maybe not in magnitudes, but in terms of responsiveness. And so I would be very interested to look at intraday bid offer spreads in the FX market. Wenxin can correct me, but I don't think she went to the intraday level on that, but they showed in their paper that indeed FX, the cost of liquidity in the FX market through the cross-currency, visualized through the cross-currency basis, really did shoot up in the same way that repo spreads shot up. Is that right, Wenxin?
Yeah, that's correct. And on September 16th, even the intraday pattern matches closely with the repo market rate spikes.
All right, so I think we have a last question from Stephen Ho, and then we will wrap up.
Thank you very much. I'm just curious. So, do you foresee a double-dip recession in 2021? And do you think the Fed and market is prepared for a repo spike up in 2021? Thank you.
Okay, so recession, I would take to be a macro business cycle effect. And here we're talking about funding market stress. Of course, they can go together when you got a slam bang instant recession like in March, and all of a sudden people are lurching for liquidity in the Treasury market. They can come together. But if there's a problem in 2021, I would say it's not going to be the slam bang type that we learned in mid-March of this year, but rather people are going to come to the dawning realization that this pandemic is going to go away more slowly than people had hoped, or maybe some other recessionary trigger that's unlikely to generate this kind of a sudden dash for cash, as it was called at the Bank of England. But we'll see. There can be all kinds of crises, and it could be one of those sorts, but I don't actually expect it, especially not with so much reserves in the system. The Fed is not going to backpedal on its quantitative, the large purchases that they've done anytime soon. So there's going to be a ton of reserves in the system.
All right, Darrel, thank you very much. If you could please, before you go, if you could please unshare your slides, and Nick has an announcement to make. Nick, you're muted. Start again.
Thank you. Sorry. Can you actually make me host so I can share my my pseudo plaque? Darrel, my role really is to thank you for delivering your keynote address and introduce you as a new distinguished fellow of the Macro Finance Society, which basically means that you have the right to be a member for life and are welcome to attend all of our workshops and meetings and participate as much as you desire, and we hope that you do find it interesting to do so in the future. Since we're virtual, I don't have the ability to hand the plaque to you. It will be mailed to your office at the GSB whenever you actually get to go there. You should find it in your mailbox, hopefully, assuming it gets delivered as it's supposed to. And again, thank you very much for a great talk, and we hope to see you at our future meetings. And so, thanks.
Nick, I want to thank you and all the organizers today. It's been really great, and are you going to include a cap and gown in the package with the plaque so I can have graduated into the academy?
It's just a plaque. It's heavy though, so you can use it to like lift weights in your office if you.
Yeah, maybe my wife will let me mount it over the kitchen table. Thank you so much.
Thank you, Darrel.
I'm looking forward to the rest of this morning. I know we're going to be talking about this topic again. I'm going to enjoy watching.
Thanks, everybody. So let's take a break until 10 past the hour, and then we'll resume the program. Thank you.